London, 2026. You're standing behind a commodities desk just after the European Open, watching three screens that normally move to completely different rhythms. Today, they're moving together. The first chart is Brent crude. 48 hours ago, it traded at $94. Now it's printing $116. Not gradually, not politely. The candles are climbing almost vertically as traders begin pricing a risk the public hasn't even started debating yet. Oil moves first because energy sits underneath everything. Airlines recalculating fuel costs, shipping contracts quietly becoming more expensive, import-heavy economies suddenly facing a different arithmetic. None of those adjustments appear in headlines yet. But inside the market, the repricing has already begun. On the second screen, gold has moved from $5,080 to $5,260. The rise is steadier, almost controlled, but every tick higher carries the same message. Capital is relocating before policy even acknowledges the problem. Institutions move balance sheets first. Retail portfolios understand later. On the third monitor, silver is doing what silver always does when the system senses instability. $82 to $91. Faster, sharper. The kind of move that appears when capital no longer trusts the time between risk and response. Then the alert flashes across the terminal. Tanker traffic is rerouting away from the Strait of Hormuz. A client message appears in the corner of the screen. Why is everything moving at once? The trader beside you barely reacts. He studies the charts for a moment, the way someone does when a familiar pattern quietly returns, then answers in a voice that sounds more like recognition than surprise. Because war hits the same three markets first. Oil, gold, silver, different assets, different traders, different incentives. But by the time governments speak, portfolios are already repriced. The first move is positioning. The second move is survival. And the sequence almost never announces itself in advance. The structure is older than the headlines. And it has happened before. What you're seeing on those screens isn't random volatility. It's a sequence. In every major geopolitical shock over the past half-century, the market has reacted through the same three stages. A pattern traders sometimes refer to, almost casually, as the war trade. Not a theory, not a slogan, just a recognition that certain assets move first when the system senses pressure. First, oil reprices risk. Supply routes suddenly look fragile. Shipping insurance recalculates, and the energy system adjusts long before governments release statements or analysts rewrite forecasts. Second, inflation expectations begin to shift. When energy costs move, the arithmetic spreads through the entire economy. Transport contracts, manufacturing inputs, food distribution. Quiet adjustments start appearing in places most investors aren't watching yet. Third, monetary metals absorb uncertainty. Gold and silver become the destination for capital that no longer wants exposure to currency stability assumptions that might not hold. Three markets, three reactions, and by the time the third stage appears on the screen, a large share of institutional capital has already repositioned. What begins in energy rarely stays there. The pressure eventually reaches equities, currencies, and credit, but only after the first adjustments have already been made, which is why professionals watch this sequence closely, because once you've seen it play out in history, the alignment on those three screens stops looking like coincidence. Step 1. Oil reprices war risk. The sequence almost always begins in the same place: energy. Oil is not just another commodity drifting through financial markets. It sits underneath the operating system of the global economy. Airlines plan routes around fuel costs. Container ships burn thousands of barrels crossing oceans. Factories, trucking networks, fertilizer plants, the machinery of modern growth runs on it. Roughly 100 million barrels of oil are consumed around the world every single day. And a large share of that supply moves through narrow geographic corridors, shipping lanes, and choke points where disruption can instantly alter the market's assumptions. One of the most important of those corridors is the Strait of Hormuz. Close to 1/5 of global oil trade passes through that narrow stretch of water. When geopolitical tension touches a choke point like this, the oil market doesn't wait for confirmation. It doesn't wait for governments to clarify positions or for economists to update projections. It reprices risk immediately. And when oil reprices, the adjustment rarely stays contained inside the energy market. Higher fuel costs begin quietly filtering into shipping contracts, airline hedges, industrial margins. Analysts start revising growth expectations. Currency traders begin reassessing which economies are most exposed to rising import bills. The first move appears on an oil chart, but the implications spread much further. We've seen this pattern before. In 1973, the oil embargo pushed crude prices from roughly $3 to over $12 per barrel in less than a year, a shock that reshaped inflation across the developed world. In 1990, when Iraq invaded Kuwait, oil surged more than 70% in just a few months. And in 2022, the invasion of Ukraine sent Brent crude from around $76 to nearly $130. Different wars, different decades, but the same reaction. Because when energy supply looks uncertain, markets don't debate. They adjust. And once oil begins that adjustment, the next stage of the sequence is usually already forming. Step 2. Inflation expectations reprice. Once oil moves, the effect rarely stays confined to the energy market, because energy is not just another input cost. It sits inside almost every physical process that moves goods through the global economy. When oil prices rise, trucking costs shift. Shipping contracts are renegotiated. Airlines hedge more aggressively. Fertilizer production becomes more expensive. Food transportation quietly follows. At first, the change looks technical, but markets begin recalculating almost immediately. Higher energy costs force analysts to reconsider inflation trajectories. Bond traders start asking a different question. If fuel costs stay elevated, how long before those costs begin appearing in consumer prices? That uncertainty spreads faster than the physical shortage itself. And once inflation expectations begin to move, the adjustment spreads through financial markets. Equity valuations that assumed stable input costs suddenly look fragile. Currency traders reassess which economies can absorb higher energy imports. Even central banks begin facing a narrower set of choices. None of this appears instantly in headlines. But inside the system, the arithmetic is already shifting, often weeks before those changes appear in inflation reports or policy discussions that most investors wait for. We have seen this transmission before. During the oil shocks of the 1970s, rising energy prices helped push inflation across advanced economies into double digits. Bond yields climbed. Purchasing power eroded. Entire monetary systems had to adapt. And while institutions recalibrate their billions, the average person simply wakes up to find their paycheck buys far less than it used to. It begins with oil, but the pressure rarely ends there. Because once investors start questioning how stable money will be during an inflation shock, the sequence moves to its final stage. Step 3. Monetary metals absorb uncertainty. Once inflation expectations begin to move, capital starts looking for something else. Not growth, not yield, stability. Because when energy shocks ripple through an economy, the real question quietly changes. Investors stop asking how fast the system will grow. They begin asking how stable the unit of money will remain while the adjustment unfolds. That is the moment the sequence reaches its third stage. Monetary metals. Gold and silver are often described as commodities, but in moments like this the market treats them very differently. They are not inputs into the economy. They are financial refugees that sit outside the policy system. When confidence in currency stability begins to thin, capital starts shifting toward assets that cannot be printed, diluted, or restructured. Gold usually moves first. It has carried the role of monetary anchor for thousands of years. When inflation expectations begin drifting higher, large pools of capital quietly begin accumulating it. Silver often follows with more volatility. It sits in a strange position, part industrial metal, part monetary refuge. That combination means it tends to accelerate once the move is underway. We saw the math play out during the 1970s stagflation, when gold surged from roughly $35 to over $800, while silver exploded from around $1.50 to nearly $50 in less than a decade. Inside trading desks, this moment rarely looks dramatic. Most of the positioning happens quietly, long before the shift becomes visible to the wider market. But portfolios are changing, and by the time the move becomes obvious to the public, the repositioning that matters has already happened. At this point, most people assume the story is simple. War begins, gold rises. But the mechanism is more precise than that. Gold does not actually react to war itself. It reacts to what war does to energy, and what energy does to inflation expectations. The trigger may be geopolitical tension, a conflict headline, a tanker rerouting through a choke point. But the market isn't responding to the headline. It's responding to the arithmetic that follows. War threatens oil supply. Oil reprices risk. Energy costs spread through the economy. Inflation expectations begin to drift. And only then does capital begin migrating toward monetary metals. That distinction matters, because conflicts that don't threaten energy supply often produce surprisingly small moves in gold. But when oil shocks the system, the reaction in metals can be dramatic, even if the geopolitical event itself fades from the news cycle. Which means the chart you saw earlier wasn't really about war. It was about a deeper transmission mechanism already starting to move. Oil shifts first. Inflation expectations follow. And once that chain reaction begins, the metals market usually isn't far behind. There is another constraint hidden inside this sequence: time. Global oil demand today runs close to 100 million barrels every single day. The scale of that system is enormous, and expanding supply inside it is slow. Discovering a new oil field can take years. Developing it can take close to a decade. Building pipelines, terminals, and refineries stretches the timeline even further. Physical energy systems move slowly. Financial markets do not. When geopolitical tension threatens supply, markets begin adjusting within hours. Traders change positions. Insurance costs rise. Shipping routes quietly shift. Prices respond long before the physical system can react. It creates a strange imbalance. Molecules move slowly. Money moves instantly. And when those two clocks fall out of sync, markets start pricing a future the real economy hasn't caught up with yet. Shift the frame to the present. The physical map of global energy hasn't changed as much as people assume. A handful of narrow corridors still carry an enormous share of the world's oil supply. Hormuz, Bab el-Mandeb, the Suez Canal. Thin stretches of water moving millions of barrels every day. When tension rises near any of these routes, markets begin running the same calculation they have run for decades. How much supply could be interrupted? How quickly replacement barrels could appear? And how exposed different economies might be if prices stay elevated. At first, the adjustment looks small: a few dollars on an oil chart, a quiet move in metals, subtle shifts in currency markets. But inside portfolios, the conversation changes. Energy importers start looking vulnerable. Exporters suddenly look stronger. Growth assumptions become less certain. The numbers on those three screens in London are not isolated trades. They are the first signals of a system beginning to rebalance itself. And once that process starts, the sequence rarely stops with energy alone. Step back and watch the pattern once more. A geopolitical shock appears. The oil market reacts first, repricing the risk that energy supply could tighten. That single adjustment begins spreading quietly through the system. Fuel costs change, inflation expectations drift, growth assumptions begin to look less certain. Then the second stage emerges. Markets start recalculating how stable purchasing power will remain if energy stays expensive. And finally, the third stage. Capital looks for neutrality. Gold, silver. Three markets moving in sequence. Inside trading desks, the pattern has a simple name: the war trade. Once those three screens begin aligning, experienced investors understand something important. The adjustment has already started. War rarely moves markets through chaos. It exposes constraints that were already there. Energy systems cannot expand quickly. Currencies cannot absorb unlimited inflation pressure. and capital never waits for political clarity. When oil reprices supply risk, the rest of the system begins adjusting whether policymakers are ready or not. Growth forecasts shift. Currency confidence narrows. Portfolios reposition. None of this happens because markets panic. It happens because the arithmetic changes. And when the arithmetic changes, the sequence begins again. Oil moves. Inflation follows. Metals respond. Not prediction, structure, whether investors recognize it or not.